We are going to concentrate on the first section of the cash flow statement, cash flow from the operating activities. And the very first entry here is cash generation from operations. That's our trading operations. And there's a note 1 for this answer because there's quite a few things to calculate to get this answer. Guys, what's important is that you learn the details. The very first section, the cash flow from operating activities, will have the possibility of these four. Maybe there was no tax, maybe there was no dividends, maybe there was no interest paid, but this is what could be falling under this cash flows from operating activities. So make sure that you know what should be here so that you know what you are looking for when you have to answer a question. Now we're going to concentrate on how do we find the information for this note 1. And here is note 1. Note 1, I took this from the New Era Accounting textbook, page 153 to page 156. This is the reconciliation between profit before tax, and cash generated from operations. So what do? We take the profit before tax as it is given to us in your information. In this case, we've got the profit before tax as 30,000 Rand. Now what we want to do with the next little section is we adjust the income statement, the statement of comprehensive income, because we say the profit before tax in your statement of comprehensive income. Let me just show you again. Your profit before tax, that's 30,000 there. That answer includes everything above. And that answer includes interest expense and depreciation. It also includes, in some cases, the interest income. But those entries are book entries. They are not cash entries. You know that you never received money for depreciation. And very often this is an accrual amount. In other words, it's a calculated amount for what we should have paid and what we should have received, but not necessarily have received or have paid. So that's important that we adjust this so that we work only with the cash. So the profit before tax, now adjust. The depreciation was an expense. It was deducted to get to that answer. Now we're going to put it back. So we're going to say this depreciation of 12,000 Rand is now a positive amount because we're putting it back. It was deducted. We now say put you back because you weren't really a cash transaction. Interest expense was an expense, so it was deducted. So now we're going to add it back because it wasn't really a cash outflow of cash. Interest income will be in brackets in this specific activity or example. There isn't any interest income, but interest income would have been added to get to your profit before tax. So now we will deduct it. And the answer of these three, or in this case 2 answers, the amounts that we have here, together with the 30,000, that is our operating profit before any changes in our working capital. So this answer is 51,200. So that's all of that together gives me this answer. And that's before the changes in working capital. So firstly, again, let me just remind you, our first section talks about cash generation from operations, and there's also an interest in the dividends here. This is not the same as the adjustment of depreciation and interest expense. These are the amounts in the income statement or in the statement of comprehensive income. These are the amounts for the financial period, for the year, that we either hoped to have received or that we should have paid, but it didn't really necessarily happen yet because it's accrual basis. So this is different. This one will be the actual interest paid, the actual dividends paid, and the actual tax paid. So don't get confused between the two. Now back here, now we get to the working capital. Again, you need to know all the details on this side off by heart, because you need to know that the changes in the working capital is part of my note 1. It's part of my note 1, and I need to know what they are. It is the decrease or the increase in inventory, the decrease or the increase in receivables, and the decrease or the increase in payables. And again, guys, when we get here, inventory is straightforward, but receivables and payables, they exclude certain entries. Receivables is not the debtors only, and the receivables, we must be very careful. If SARS falls under receivables in your information, if SARS falls under your receivables in your information, you have to exclude SARS. If SARS falls under your payables in your information, you need to exclude SARS. If your interest expense falls under either of the two, interest expense, if it falls under either of them, do not include them. It is dealt with in this section. It is dealt with in that section. So do not include them. And the other one that we don't include is dividends, shareholders for dividends. Do not include this one either. So if your information has got all of that in it, exclude them and use only those like the accrued income, accrued expense, debtors, trade creditors, deferred income, and prepaid expenses. Those that are the ones that you use under your receivables and payables. Not these. There are separate calculations for them, so we don't do it double. So again, straightforward learning work. I must know this to get to the final answer of my cash generated from operations. Now, this changes in working capital is sometimes quite interesting and not always that easy to know whether it has decreased or increased, because what's important is we need to put a bracket here or no bracket. And to know whether it's a bracket or no bracket, you can learn it off by heart, or you can use this for an example. This could be helping you a little bit if you learn these acronyms. So what we do is we say, when we need to calculate whether my inventory or my receivables or my payables, whether they actually decreased in cash or increased in cash, or whether it was an outflow, we use these acronyms. We say AU leak. So assets increase, money is used, so your answer will be negative. When assets decrease, money is made, or generated, so your answer is positive. I try to remember just the AU leak, and these are just the opposite. So the leak, when liabilities increase, money is made, generated, positive answer. When liabilities decrease, money is used, so it's a negative answer. So let's have a look now and see how we're going to apply this AU leak. We have had in the textbook, we've got inventories, 52,000. I'm just going to write it here for you. We had even inventories was 52,000 at the beginning, and it is now 60,000. 50,000 and it's now 60,000. So let's see. Inventory is an asset. The asset has increased. So money was used. Let me do that again. This was the beginning. This was the end. What happened to inventory? it increased. Inventory is an asset. Asset increased. Money was used. So my answer is in a bracket. Now that looks interesting because from 52 to 60, we have an 8,000 Rand. We have 8,000 Rand more. So how is it negative? That is an outflow of cash because we have to concentrate not on the inventory amount, but on the cash because we're busy with the cash flow statement. And that is why I say, in order to not get confused with this, look at the AU leak and the opposite of it. Right, let's go to the second one. The second one is receivables. And in this trade and other receivables, we have, just to give you an example here, in the textbook, we have under trade and other receivables, no extra information. It is only the two amounts that's given to me. So my trade and other receivables doesn't have to exclude anything. And the amount that we are dealing with is from 28,600. Now look at this. 28,600 at the beginning. It has now gone to 23,000. Now, what do I do now? Is it a bracket or no bracket? We need to establish has it decreased or increased. Well, it has decreased. Now, if an asset decreases, we just get back there. If an asset, receivables, decreases, money is generated. So it's made. So it's positive. So it has decreased in value. And because it has decreased in value, our outflow of cash wasn't that high. In fact, it was much more of an increase in cash. So again, apply this AU leak idea, the acronyms here, and apply that to establish whether this is a bracket or no bracket. Let's go to the last one, which is our payables. And now let's have a look here. In our payables here, we have trade creditors. Yes, we've got to take it. No SARS, no shareholders, no expenses payable. So it's just the difference between the 292540 and the 26,800. So that's just that difference. So let me write it here as well. So we exclude all the other payables, and the beginning of the year was 26,800 for the trade creditors, and the end was 29,240. So it has increased. And if my liability, my payable, if it has increased, money is generated, so money is made, and the difference between the two is 28,600. Let me just quickly calculate that. 28,600 minus 29,240 is, oopsie, have I got it right? Let me just get it. 29,240 minus 26,800 is 2,440. So it is a positive 2,440. I just want to repeat this again. Here we have an increase. Here we have a decrease. And here we have an increase. And now look at this. The increase in the inventory caused us to have an outflow of 8,000. A decrease in receivables caused us to have an inflow. An increase in the payables caused us to have an inflow. Right. Now, the answer of these three, the answer here is just a 40 Rand. And now the final answer, what is the amount that's going to go to my cash flow statement next to note 1? What is that answer that's going to go there? And here we have the 51,200 plus the 40. That is now this one and this one. That will give me that answer. And that answer is 51,240. This, guys, is the explanation and the calculation of note 1 So now for the cash flow statement, all we've done now was to calculate this 51,240. I will continue in the next video with the interest paid, dividends paid, and tax paid. But please make sure that you know all the details that could be in the calculation of this note 1, and that you learn what must be excluded from receivables and payables, and then that you use the abbreviations that are used to calculate the changes in working capital.